My name's Charlie Armstrong. I'm an industrial specialist with NAI Ruhl Commercial. I'm going to be giving you the industrial report today. I'd like to thank Alex Kelly and Rick Schaefer, who assisted me in the research and compilation of the figures we're going to talk about today. The market that we analyze is the greater Quad Cities market, which would obviously include the Quad Cities, Clinton, DeWitt, Galesburg, and Muscatine. So the figures we're going to talk about are really pretty contradictory. And on one hand, the gross square foot absorption was down. The dollar value of the industrial buildings was down, but the number of transactions was significantly up. So here we're going to get into some graphs, and we're going to talk about gross absorbency and vacancy, and this is pretty exciting stuff, so hang on to your seats. I don't want anybody to get hurt. So if you look at the graph here, the number of sale and lease transactions were up 63%, which is good activity. But of those 67 transactions we did in 2014, 62 of those were for buildings under 30,000 square feet, and 40 of those 62 were for buildings under 10,000 square feet. So you can see we had a lot of small deals that drove the market last year. If we look at the sale and lease, there we go, transactions, they were down 9%. And the gross square foot absorption, they were down 24%. And a better picture for all of that is to really look at kind of a 6-year chart of gross absorption. And you can see that we had a low in 2009 during the recession, got back to pretty good activity in 2012. 2013 was a great year, and we were down 24% in 2014. So the question is, what are all these contradictory figures telling us? Obviously, a lot of small transactions drove the market, but in 2013, we just simply had a great year. And a lot of the large buildings that had been on the market during the recession, we cleared those out, they sold, and we didn't have any good large functional buildings left. So we had a shortage of buildings over 30,000 square feet, and we had a huge shortage of buildings over 50,000 square foot. We had lots of requirements that came to our market, people looking for 100,000 up to 400,000 square feet, and we had to turn these prospects away. We couldn't fill them. So that obviously reduced our dollar volume in 2014. Last year in the presentation, we told you about a trend to lease versus buy and how that was increasing. And if you look at the numbers in terms of purchasing activity, that was up 46% from the previous year, but leases were up 93%. So that trend is obviously continuing. Another significant trend we reported last year, and has kind of been talked about earlier, was the preference to buy or lease buildings in Iowa versus Illinois. And if you look at the numbers, Illinois, number of transactions were up 12%, while transactions in Iowa were up 100%. If we look at it in terms of gross square foot absorption, Illinois was down 58%, while Iowa was up 5%. And even more startling, if we look at dollar volume of transactions, Illinois was down 62%, while Iowa was up 67%. These are huge disparities in our market, and they directly translate to longer listing times and higher vacancies for Illinois properties. Another interesting fact is, and I just told you how leases are becoming more and more prevalent. In Illinois, sales outnumbered leases at all levels, and I can't explain that, it just is what it is. So if we look at transactions in 2014, these would be some of the major ones, and you'll see we only had 2 transactions over 100,000 square feet, and of those top 11 transactions, 3 of those were Illinois, and the remaining 8 in Iowa. So if we look at trends that took place in 2014, activity was up significantly, absorption was down, our inventory is down, and vacancy was down slightly in 2014 and has actually upticked a little bit and is slightly up in 2015. If we look at the Quad City industrial market as a whole, we have 50 million square feet. And this would be everybody, the Alcoas, the John Deeres, the Rock Island Arsenals. Iowa represents 62% of that total, Illinois 38%. Manufacturing would make up 40% of it, and warehouse storage would be 60%. Just to give you some perspective for the 50 million square feet that we have, our neighbor to the east, Chicago, has 1.2 billion square feet, about 24 times larger. And right now, as we speak, they have 15 million square feet of new product under construction. Let's look at pricing for industrial product. In spite of the shortages that I've discussed that we had last year in all size ranges, especially buildings to purchase, the prices remained steady throughout 2014. Buyers continued to be very aggressive, having been trained all through the recession. Sellers were still in a recession mentality as well and didn't have the confidence to raise prices. If we look at the factors that affect pricing, because pricing can vary widely, similar to office, they would be location, quality, the features, size of the building, and age of the property. So in actual pricing, large bulk warehouses would run $1.75 to $2.50. These are all on a triple net basis, exclusive of taxes, insurance, and utilities. Distribution properties, $2.50 to $5.50 triple net. Manufacturing, $2 to $5. And flex space, and that's typically a industrial property would have a 10% office finish. A flex space would have office maybe 25 up to even 75%, would run $5 to $7.50 a square foot. If we look at sale prices, they would kind of fall in the range of $15 to $40 a square foot. We have some that are lower than that and some that are higher, but generally they'll fall within those range. In 2015, we're beginning to see price increases on a lot of these numbers, especially in the newer buildings with good features. And frankly, we need to have these prices increase. They've been stagnant for about 15 to 20 years in our market, and we're not going to entice developers to build new product unless we get higher prices for what we have. If we look at development that took place in 2014, Alcoa spent $300 million on a retrofit, but didn't really add any more square footage. FedEx is just in the final stages of finishing a 189,000 square foot package delivery center. GDRC is working on an 11.39 million rail transload facility. Sadler Powertrain put up a new building in the Eastern Iowa Industrial Center. City of Clinton had a couple of nice new developments in their Lincoln Way Industrial Rail Park, Rail 1 and Nevada Railroad Materials. But the bottom line is we need new spec space. At the present time, there is one building being planned. Build to Suit is working, with cooperation of the city of Bettendorf on a 60,000 square foot spec building in the Riverside Industrial Park. And that, if it goes well, will be expandable up to 200,000 square feet. If we look at vacancy in our area, we track buildings over 50,000 square feet that are either multi-tenant or single-tenant that are leased or are on the market for sale or lease. Iowa had a vacancy of 17%. Illinois had a vacancy of 18%. And while these numbers look high, they're well below what we were running during the recession of 35%. If we look at the total industrial vacancy in the whole Quad City market, and now once again, we're including the factories, John Deere, Alcoa, Rock Island Arsenal, we're a low 4.4%, which is good. And this is for all buildings over 50,000 square feet. As far as a forecast for 2015 and beyond, as I said, we had a shortage that started in 2013, and that should have led to more spec building, and it hasn't. We didn't get anything in 2014 that's completed. We've got one on the books, but we need to have more of that. But along with the economy that's slowly improving, what we're going to see is more industrial demand. Our vacancy rates will go down. The rental rates will go up. And we still have a question on industrial development for spec buildings, and sooner or later we're going to have to get that. As far as strategies go, as the market adjusts to the lower vacancy and inventory shortages, landlords and sellers will become more aggressive and pricing will increase. Now is a good time to finance buildings. Interest rates are at an all-time low. As far as buyers and tenants, they're going to need to make some quick decisions. They won't have time to mull over deals, and it's going to be an interesting market going forward.